Dipan Mehta, when everybody was, in a sense, worried about FI flows, what will happen to Donald Trump, what will happen to dollar index, high, हर जगह हो रही थी, markets have bottomed out. But have they bottomed out? That's the question, Dipan Mehta.
Oh, have they bottomed out?
It looks they bottomed out. They can come back down again.
Yeah, Nikunj, good morning. Good morning, and thank you for having me on your show. I think if there's no further bad news, then you can say that you have a bottom. But we live in dangerous world and interesting times, so there could be any blowout at any point of time anywhere in the world, which may impact the sentiment. But all the bad news so far that has got discounted, and some of the concerns around slowing growth, they also have been gradually addressed. So I think that we should see improvement in markets from this point on. And the focus should be on India growth stories or domestic oriented businesses, because this Trump tariff is still remaining a big kind of a sword on a lot of industries which are externally focused. So I would say that maybe the worst is over unless there's additional bad news. And certainly investors should raise their exposure to equities.
So Dipan, the obvious next question is, where within the equity pool would you raise exposure?
So four sectors we have identified. First is banks and NBFCs, more preference for NBFCs than banks. Second is surprise, cement. I've never been very positive on cement for the last several years or so, but this time around, it looks to be in a good trading opportunity. The third is retail, especially specialty retail or tier two retail companies. And last is engineering construction companies, the likes of Larsen & Toubro, Afcons, ITD cementation, those kind of stocks. So these are the four sectors where we want to be an overweight. In fact, I think investors can have 70-80% of their portfolio within these four sectors. And that can, I would say, high degree of then outperforming the broader indices or some of the other benchmarks.
That's quite interesting that you say cement, Dipan. So again, what within cement? The largest of the players, or would you say, have a basket approach?
No, I think the two cement companies are really interesting at this point of time, ACC and Ambuja. And the reason for that is that I think amongst all the cement results which came for December quarter, they had the best in class. Secondly, I think that the productivity gains and the logistic efficiencies are really showing up in the numbers of these companies, and they're very aggressive when it comes to M&A as well. So I would say, and valuation most importantly is would say quite reasonable. So I would put a preference for these two companies. I think risk return profile also is quite attractive.
Okay.
But Dipan, you also talked about as to how you're more bullish on NBFCs other than banks. Again, where within NBFCs do you think one should add positions? Would it be the obvious Bajaj Finance and a Shriram?
Not Shriram, but Bajaj Finance and Cholamandalam Investment and Finance. I think these two companies, first disclosure, we have investment in both these companies, so our views could be biased. But both these companies have managed all the kind of volatility and stress within the NBFC sector far better. And especially their NPA collection has been pretty decent. Balance sheet size does matter in NBFC, as also the fact that both have a pretty diversified product offering. Bajaj Finance more than Cholamandalam as well. And that means that by buying Bajaj Finance or Chola, you get access or exposure to all the segments within the NBFC. So very positive on these two companies, but I'm sure some of the smaller ones also will do equally well, the likes of say IFL Finance or Poonawalla FinCorp, and some of the other smaller L&T Finance also, I would say could do pretty well, because the basic, I think, environment for NBFCs is improved. The reduction in risk weightage means that liquidity will improve, their interest rates may come off. And with the economy picking up and consumption expenditures picking up at the family and household level, there'll be more opportunities to lend for the NBFCs.
Okay. What's your take on Jio Financials? Do you believe that at this price point and given the news flow for now that the company is gearing up for their major entry into the insurance business, is this a good time to enter into Jio Financials? And what is your read-through from this news flow?
See, although we are positive on NBFC and financial services, not that much on Jio Finance, a bit disappointed with the scale up of operations, and I think there are better opportunities elsewhere. So I would feel that better to go with the Bajaj Finance or Cholamandalam or even L&T Finance, IFL. I think they have better risk return profiles than Jio. And it's getting into many things at one point of time. So many businesses getting incubated in geofinance, and all these businesses have certain startup related costs which impact the bottom line. So from a valuation perspective, also geofinance doesn't appear to be that attractive.
Okay, that brings me to Dipan, Reliance as well. And especially, I know Kunal says that the stock has a typical behavior. It doesn't really move up in a bull market or fall in a bear market. It has a trajectory of its own where it goes into very, very long phases of consolidation and even underperformance, if you will. But what could be really that big trigger which will actually move Reliance from this, kind of range that it's been stuck in for so long?
Well, I think one, of course, is performance. So every time if the performance is beyond what Street is expecting, then that could cause a trigger. But more importantly, I think there are structural issues with Reliance, with lack of clarity on how they are going to list the businesses, that is the telecom business, Geo, and the retail business. So unless there's clarity over there, I think this stock will continue to underperform. And more and more, it does appear that they want to do IPOs for both these subsidiaries, and that's not very good for Reliance shareholders, because then Reliance becomes purely a holding company, and then the holding company discounts start to creep in for businesses which are listed separately. So I would be a bit cautious on Reliance, and growth rates also have been kind of slowing down. So I would say that there are better stocks within the large cap. No doubt a great company, but not necessarily a great investment at this point of time.
Sure, that's for fresh investments, Dipan. But this is one of those core portfolio stocks. If you already have it and if you're in the money, do you exit is the question.
See, first of all, if you're benchmarking the Nifty and the Sensex, then you have to have a holding in Reliance. You may be underweight compared to its overall weightage in these indices. But from an investor's perspective, where they're looking for absolute returns, I don't think it matters whether you're in large cap, small cap, and don't need to necessarily have Reliance in your portfolio. There are many other stocks within the mid cap space, large cap space also, which have far better growth rates than maybe Reliance Industries.
All right, that's the take coming in on Reliance. But
much like Reliance, would you say steer clear from IT as well? I mean, even though the index has fallen about 16% year to date alone, but the NSE IT valuations, on a 1 year forward basis at 24 times are still pretty expensive. And this along with US uncertainty.
Yeah, I tend to agree with you. And again, it's the same situation like Reliance. If you're benchmarking the Nifty or the Sensex, then because of high weightage of TCS, Infosys, you need to have them in your portfolio. You can be underweight them. But from a retail investors perspective, I think you can avoid every single large cap IT stock. And these companies have really just not shown growth for the past several years or so. Despite rupee depreciation, I think TCS, Infi have got like a 10% type of revenue growth for the last 10 years or so. There are a few select mid-cap IT companies where there is still a lot of, I would say, growth potential, but they are expensive and you need to buy them at correction. But I think that correction also is over. So we need to be very selective when it comes to software companies and focus only on the companies which have demonstrated that they can grow at the mid-teens and not at that typical 8-10% type of growth rate, because companies growing at 8-10% top line will never give superior returns over the longer period.
Quite interesting. Dipan, which mid-cap IT companies were you talking about?
So I think the list is obvious if you do a quick screener, like so say Persistent Systems, Newgen, Oracle, to an extent KPIT, but I'm getting a bit more cautious on KPIT. And then there's Coforge as well. So these are the companies which have been able to grow far better than the industry averages or their peer group, but they're expensive also, rightly so. But that's where I think investors, if they want to invest in software companies, that's where I think they should be looking at.
all right, so look out for some of the IT names within the mid-cap basket. But Dipan, help us with your take on some of the favorites of 2024. Case in point being Zomato, Paytm, as well as PB Fintech, because just yesterday we have seen a move of 7 to 8% on some of these counters. And yes, they were favorites of 2024, and those were the counters having high PE, high growth prospects. But yes, with the market fall, they did participate in the sell-off that we have witnessed. But do you believe now is the time to maybe once again look into some of these counters?
So I think these are high beta stocks. So when the market falls, they fall much faster. And when the market rises, they tend to outperform also spectacularly. investors should have exposure to these new generation companies, these platform companies. And if you don't have that, this is a good time to get into these companies. Disclosure, we and our clients are invested. EB Fintech in particular, I think after the clarification came about their healthcare strategy, some amount of uncertainty has got, I would say, uncertainty has been addressed over there. And, it's a good, interesting business model with great scaling opportunities and I would say reasonable valuations. I think actually all three companies, they have got great growth potential. And if you hold them for a long period of time, 3 years, 5 years, 10 years or so, they can deliver superior returns. But you have to be ready for a lot of volatility in their stock prices and their earnings. And there could be even corporate actions which may not be completely aligned with, or may appear to be a bit of earnings dilutive.
Interesting.
Dipan, there is merit perhaps in not just HPCL, BPCL. Some would say that one thing is evident, that the US administration will do whatever it takes to keep crude down, because it is perhaps important for them to keep crude down to manage their expenses. If crude is directionally lower, if wars are getting, ceasefire rather than wars now, is it time to buy crude derivatives? It may not be HPCL, BPCL, I still think they're regulated, but let's say Pidilite, Asian Paints, it easily may be anything and everything which has got to do with transportation.
So Nikunj, if you want to play the investment theme of lower crude oil prices, the best way is to buy the oil marketing companies. And I think that they are getting a lot of investor interest and a lot of expansion plans going on stream for all the oil marketing companies. The investments which they have made, I think a lot of them are reaching commissioning stage. And lastly, I think that valuations are really attractive over there, and it's a neglected sector. So you always have this, kind of thought process that neglected sectors may do well in the next phase of a bull market. So from that point of view, also HPBP, IOC, there's scope for earnings to improve because of lower marketing losses, and also the fact that P multiples can get rated upwards as there is more certainty around their profitability. So I would say that from an investor's perspective, if you want to actually even lower the overall PE of your portfolio, these stocks are good to invest for the next 6-12 months, maybe a year or so. And then let's wait and see how oil prices actually, perform over the next few quarters or so.
We've been discussing metal stocks, and the logic here could be China is getting better, Europe is stimulating its economy. You do have a sense that things are looking up in terms of where the European dominated businesses are done. But one company which I think could really be attractive, and Dipan, I'll take my chances with this one, is Tata Motors. The dependence on JLR, everyone thought that is going to be a curse, then it became a boon, now it's become a problem. But at current level, if somebody is buying Tata Motors, are you buying a good company at a decent price?
See, it's a difficult question to answer because right now Tata Motors could be a value trap as well. No doubt its valuations are very attractive, but the way the uncertainties there around JLR, I would just like to avoid Tata Motors. Our bias is more towards other auto companies, maybe Maruti, M&M, Eicher Motors, and there's only so much exposure you can take to automobile companies. And there are a whole host of auto ancillaries also which have corrected, pretty nicely. And they're also pretty interesting because most of them are not impacted by the shift from ICE to EV. So I would say that given so many choices, I would go with other auto ancillary companies rather than Tata Motors. But look, Tata Motors does have a way of surprising investors on the upside and the downside. So one can't really say. But all I can say is that fundamentally, it's a very difficult company to track and had a handle on.
Within pharma, could it be Dr. Reddy, could it be Cipla, could it be some of the domestic companies? Very difficult to fathom. But for the moment, it clearly appears that from a tariff standpoint, whatever adjustment we saw in some of the pharma companies, that now seems to be, adjusting. I think it's quite evident. Dipan, more and more reconciliation in the market seems to be coming that if tariff on pharma is imposed, it's going to hurt the US economy more than it will affect Indian pharma companies. While it may help the US trade deficit, it could increase healthcare costs, which is actually a bigger burden. So should one buy into this entire pharma suspense or tariff suspense pharma stories?
No, Nikunj, I don't think so. And the reason for that is that if there are levies on import of pharmaceutical formulations, it's certainly going to affect the profitability of these companies. It's easy for the management to assume that they'll get passed on, but it doesn't really work like that. And I would just be a bit cautious when it comes to pharma. Also, we are seeing mild slowdown in the domestic market sales also, so that's also a bit of a concern. And base effect also is coming into play for a whole host of pharma companies. So I'd be a bit cautious. But once we have clarity on Trump tariffs and once we know for sure that what exactly is the import duty he wants to put on pharmaceuticals, then there could be interesting bets over there. And but within the pharma space also, if you want to be overweight, I would go for the CDMO players. I think they are to an extent more protected than pure generic players. Companies like say, Divi's Laboratories, Suven Life Sciences, Piramal is there, and there is this one source, the new listing, which has been, from split out from Strides. There's Blue Jet, I think that's if I got the name correct. So these are companies which I would say I would focus on and increase our coverage over there. Because these businesses, I think, have great potential considering all the various industry dynamics taking place over here.
All right.
Few stocks in general have had it. I mean, there was this entire phase where anything which had PSU association directly or indirectly, those stocks were getting re-rated. Is it time to say goodbye to PSUs and only select PSUs now will go higher?
No, Nikunj, I don't agree with that. And in fact, when we are so positive on banks, NBFCs, I think preference is for PSU banks. Their growth rates, their NPA levels, their technology platform service levels are fast catching up and kind of coming closer and closer to private sector banks. So that's certainly one sector that we would like to be positive on. And then there are the PSU engineering companies which are in the defense space and non-defense space. I think they're sitting on very good order book positions. So there's good earning visibility over there as well. Valuations also are quite reasonable. So I don't think that the PSU rally on a longer time frame, like 5-10 year time frame, is over and done with. I think you may see a good outperformance over there as well. It's just that the large part of the growth, when they're being multi-baggers, so a lot of them last 4-5 years or so, that phase is definitely over. But still, I think they have got pretty decent potential to deliver at least industry, or I would say index beating returns.
All right, let's watch out for the PSU counters. But Dipan, we let you go on that note. Really appreciate you taking the time out and speaking with us this morning.
If you like this video, then like, share and subscribe to ET Now.